Welcome to the Gray Report. Apartment prices have dropped for 3 months in a row as national rent growth is negative and month-over-month rent growth is also negative. What does this mean going forward? And does it make sense right now to buy apartments? Is it better to wait until we get into 2026? I want to be talking about that with our Chief Investment Officer here at Gray Capital, Jay Reeder. Also going to be getting into some new reports from RealPage as well as Realtor.com, looking at the single-family home market. And then again, I'm going to get into Jay with just what makes sense to buy right now. How do we pencil deals? How are we underwriting in a market fueled by uncertainty? Do you look at those long-term fundamentals or do you focus on just what's right in front of you? Well, if you're a multifamily investor, active and passive, you are in the right spot. This is going to be a great episode. Make sure you like, subscribe to the Gray Capital YouTube channel so you can follow along for more. Let's get into it. Welcome back to the Gray Report. Joining me once again is Jay Reeder, Chief Investment Officer here at Gray Capital. Jay, how we doing?
Doing well. Happy to be here.
Glad to have you back on. It's always exciting because we're always looking at deals. We're also banging our head against the wall more and more as we're trying to make sense of things. And what we're going to talk about closer to the end of the episode is this challenge of where we're very bullish on the long-term fundamentals, and we can talk about that too. But the near term, we're so uncertain, especially 2026.
Very much so.
And sometimes, we have to just manage the emotions and the psychology of trying to make decisions and, trying to parse through data, but also using intuition, but not letting our emotions take hold of ourselves. So I'm excited to talk to you about that. But first, I want to get into this report from RealPage titled U.S. Apartment Prices Fall for the Third Straight Month Amid Easing Occupancy. And then a quote, so price declines across the U.S. were inspired by easing occupancy rates. U.S. apartment occupancy fell for a third consecutive month, dipping to 94.9% in October, according to data from RealPage Market Analytics. Occupancy was 20 basis points below September, showing and down 60 points in the last 3 months. However, year over year, occupancy actually was up 10 basis points, which was a little surprising to me. So some higher vacancy, lower occupancy, and this is also being, fueled or leading to some rent declines. So, nationally, annual rent change were down almost by a full percentage point, now down negative 0.7. We're going in the winter, right? So we're probably going to see further declines, most likely in November. December typically isn't the hottest month, and neither is January. Monthly rent change, 0.8% for an average effective rent for the nation of $1,858. Now, demand has been strong, but I guess how is this translating from an asset management perspective when you look at our portfolio? Does this resonate with what's going on, what we're seeing?
Oh, it's definitely what we're seeing. And I think you and I kind of started seeing it. I mean, I remember sitting in our asset management meetings in March and we're like, holy cow, we're going to recover from kind of the slump of last year.
Yeah.
And then all of a sudden, April, it's like, okay, maybe people just kind of pushed up and were more aggressive in March rather than April. But then all of a sudden, May came, June came, and we saw this steady decline where, one of our largest properties, we had one lease for the entire month of July.
Yeah.
And it was okay, fortunately we did some really good pre-leasing and we were a bit more proactive on some of these things. But you definitely see the results in kind of the meetings we're having in asset management of protecting ourselves going into winter and understanding kind of what our exposure is, because sitting at 95 and people paying bills is a lot better than trying to get traffic that doesn't exist and sitting at 89%.
Yeah, I feel that. So I've heard the argument being put out there that, kind of like you said, demand was just pulled forward a little bit, and the leasing season has just shifted a little bit earlier. So we just had more leases in March, but it was basically the same. Just it was a little bit front loaded. Does that carry much water?
I don't think so. Did we see that on the margins maybe in April and May? But to see just the dearth of activity across our portfolio in June, July, and August, there wasn't enough traction in March and April to say that those people just moved up.
Yeah.
Now, the one thing we can say is a lot of people were staying put. Our renewal rates across our portfolio were incredible. I think at one of our largest properties, we had like a 61% retention rate this year.
I think the highest, I think another property, it was basically at 70 to 69%.
Yeah.
But a lot of our assets are right at 60% versus the average of close to 50%.
Yeah,
is what
so
you
I
typically
think
see.
that helped a lot. But if all of these people are staying put at other apartment communities, then that's something that I think we just had to deal with from a traction standpoint, because I think in the past people were kind of shopping, hey, I want to stay here, but if I can get a good deal over here, maybe it's worth me moving. I do think that the market has found somewhat of an equilibrium where it's really hard. I mean, I know we've kind of put together some marketing information at some of our properties of like, yeah, you say you want to move, you don't like the renewals that we're giving you, but here's how much it's going to cost to move. Here's how much a deposit you're going to have to put down. Here's how much all this, like, you average that out over the increase that we gave you and you're coming out money behind. And I think people are starting to realize that. And
Yeah.
I think that people are like, you know what, I'm going to stay. Yeah, maybe my renewal was 7-8%, but I'm still below the market and I would be up 12%. Maybe that place has a concession, but I'll get for 2 free months, but then I'm going to have to pay that every month thereafter. And I do think we're seeing some of that in the market.
So, renewals are plugging some of the hole from new lease traffic. Is it enough are we basically just treading water with those renewals? Or making any significant growth?
From an income standpoint, I would say I'm probably 2/3 of our portfolio. I would say that the renewals we're pushing them enough to say that we're moving forward. There is a portion of the portfolio that we're getting the renewals, but we're kind of treading water. And so I do think that it's situation by situation, and it just kind of depends on where the property is in the market and kind of what the resident sentiment is. But I would say there's one property right off the cuff. I know it's like you and I have talked about it. Our income is virtually identical September of 2024 versus September of 2025. One of our best properties, but there's just no movement in that market.
And expenses aren't flat.
Aren't flat. Then I have another property, and that one, I remember last year doing the budgets, and I remember our partner on the deal was like, you're being too aggressive. Like, they're not going to hit it. And we've basically hit it with renewals this year. We're maybe off fractions of a percent on our income. But I mean, we have just been blowing it out of the water. I think we're at like average 8% on renewals, and like new leases. Some months we are 10%. So, I mean, that one, I can see that we are far beyond treading water at that one. But I think some of them that had kind of already hit the peak definitely were treading water.
Yeah, that's I think that's what pretty accurate description. So kind of going back to this, pulling demand forward, even though it didn't make up for like the volume of new leases in March, for the lack of volume throughout the rest of leasing season. The reality is, though, I mean, there were a lot of leases signed in March, which means that a 12-month lease they're going to be renewing in March. Going forward, I guess do we see that leasing season maybe not necessarily start earlier, but start stronger in March and a little bit more even throughout the rest of the months?
I think it's going to be us being conscientious of our kind of renewal wall. I mean, we had one property where I think 60% of the leases expired in like March, April, and like the first half of May. Fortunately, that one renewed a lot, but that property specifically, I looked the other day, and we've very much evened out kind of that wall of expirations.
Yeah.
And so that property I feel pretty good about kind of where they are between now and kind of when those renewals come up next year, even if it pulls forward a little bit. Some of the other ones, I mean, we have some properties in some student markets that it's just hard. Like, even if it's not a student property, and we don't live in the student world, but we are affected by the student calendar very much, there are just some that March is just hard. I mean, in March in a college town, that's spring break. Like, there aren't people there. And so it may never pull forward in those markets. And so then we feel the stress come end of April, beginning of May, into June, before kind of it's a ghost town in July, and then just kind of hope that everything picks up in August.
Yeah. So the dynamic pricing is also impacting kind of these lease expiration schedules. It's something that we talk about more and more because we use dynamic pricing in a portion of our portfolio, and more frequently for projects that we're underwriting to buy, they're using dynamic pricing. Can you just kind of briefly explain what dynamic pricing is and how that may be changing the market from operations, but also acquisitions?
Yeah, and I mean, we had a whole conversation on it here probably the last 2 days in our office, and obviously there's been a lot of talk about the dynamic pricing in the news with the lawsuits. I think the products themselves have kind of adjusted, and we could sit here and talk with Katrina. She's a great person to bring in, but they really kind of focus on internal metrics now heavily just because of some of those safeguards that they put up. And one of the deals that we're looking at right now that
first, just you could do a kind of brief overview, like what dynamic pricing is, if someone's not familiar with just
for
the
dynamic
term.
pricing, it's just, hey, basically our price is reset every day.
Yeah.
And it's, hey, you come in today, you get quoted, this is the price for today. But if you don't lease today and you come back tomorrow, you may be paying a different price.
But and it's not only on the different day, but the price also changes based upon your move in, when you want to move in,
Yeah.
and when you want your lease to expire. And so that there's less and less. And there's still the majority of leases are still 12-month leases because people are like, I want a year lease. But there's a whole matrix of you want a 10-month lease, you want a 14-month lease. It may be cheaper to do a shorter or long-term lease based upon what our lease expiration schedule is.
And that's probably the biggest thing is like we have kind of caps for each month of how many leases we're willing to have in each month. And Katrina kind of says a good rule of thumb is no more than 13% of your lease is expiring in one given month.
Yeah.
And so basically what happens is kind of once we hit that cap, even if it makes sense, we just don't want that exposure. So it makes it a new person coming in off the street much more expensive for them because we have to compensate for the risk on the back end of the increased vacancy if we have too many people leave in that month a year from now.
So like someone, I want a 14-month lease, but that's going to make it expire in January. And like we don't want too many leases to expire in January because no one's or December. No one's looking for an apartment, right before Christmas.
Yeah.
And so it's like, okay, your lease can expire in December, but we're going to charge you an additional $100 per month because we're going to amortize that vacancy because we're going to have to hold on to it for another month or two. And so I guess, when you're looking at deals, underwriting to buy, how do you take that into it? And we're actively, doing this, but how do you think about taking that into account? Because also it's like when you ask, what are your 2 bedrooms going for? There may be a $200 or $300 difference between what people are being charged on the rent roll, depending on when they sign the lease and when their lease expires.
Well, and that's the hard part too. And we just have to really kind of dig into the rent roll because, I mean, the in vogue thing to do is like, what's the average of the last 3 leases signed?
Yeah.
Well, okay, what's the average of the last 3 leases signed on a normalized amount? Because like the last 3 leases signed, maybe someone, it's not even a short-term lease. Maybe it's like you said, a 14-month lease, but like that's what they have to do for whatever reason. But their AIRM or their revenue management or whatever they're using is set up like, hey, we're not going to. Well, that's artificially inflated that rent. And I know Addison has gone through on a couple of deals that we've looked at that were kind of lease-up type deals that all of a sudden, like they signed some really, really strong leases and got some really good rents in like October, November. And it's like, why would you do that? But then you get to like March of the next year and the rents are $100 less. And it's like, what's the real rent? Is it the $1,600 that you signed last November? Or is it like the $1,400 you just signed?
Yeah.
And it's like, why could you get that in a harder month, but not a prime leasing month? And that's the real struggle that we kind of come across is we just see these anomalies of like, why were you able to sign this above market lease here, but you couldn't keep that momentum here?
Yeah. And often is that when you look at it, it's a 9-month lease.
Yeah.
And so it's not that you can achieve that on a 12-month lease if someone had a very specific need to have a lease expire.
Yeah, they needed it. But then like as an owner, the owner's like, well, I got this lease that shows there are people out there that are willing to pay for it. And so it kind of creates this friction of expectations of what the market is from a buyer and a seller standpoint.
And say, or a broker saying, look what they achieved. You can
Exactly.
achieve that across your entire rent roll when that's just not the reality. But if someone sees that and believes it, that's what they're going to bid, and that's what you're competing against.
And then like the conversations we've had today and yesterday with those revenue management, what are you solving for?
Mm-hmm.
Are you solving for getting the absolute most rent you possibly can, or are you solving for being as occupied as you can? And I have one theory, but the owner that's selling it has a different one, but I don't know how they've set up their AIRM. I'm making assumptions that we're going to have similar setups, and we could have vastly different results on that revenue software if we just change those parameters. And that's something that we're digging into right now on a deal that we like, that we know uses revenue management. It's like, okay, we think that there's some room here for rents, but how did you set up your AIRM? Because in my head, and the conversation I had with you is like, they're on revenue management. They should be maximizing the amount of rent they get. So how can I say that they can get $150, $200 if they're on revenue management should be getting it? But if their parameters are set to a way where it's like, no, they're really protecting for occupancy, then revenue management isn't going to push their rents. And so not knowing that is hard for us to underwrite what's actually possible, even though there's comps in the area that say there should be meat on the bone.
Yeah. What do you think about, just going back to this RealPage report, a theme of the last really year and a half, 2 years is, while we've been delivering a lot of supply, 474,000 through the third quarter of 25, demand has been really strong. I mean, in terms of absorption, there's been 637,000 units of annual demand through the third quarter. I mean, that's a little less than $200,000 unit difference. Pretty substantial. Obviously, there's demand out there. People need housing. There's a housing, crisis, but that doesn't necessarily mean people can pay whatever. There's certainly some resistance for pushing rents in the current environment. What kind of square that for us when we see that kind of demand?
I think
that supply and negative rent growth.
I think the easiest thing I can equate it to, and I think we've all talked about I'm going to take a couple steps back, but we've all talked about the progression of the industry. It always starts in hospitality, moves to student, and then it filters to kind of market rate multifamily. And if you look at it, obviously all of these new deliveries were the bright, shiny new thing. So the idea is that people want to live in them.
Yeah.
Can people afford them? Maybe, maybe not. But right now, I mean, you and I drive by the north side of Indianapolis. There is a lot of supply north side of Indianapolis, Hamilton County, that are giving concessions that people are able to move into those nice new apartments.
Yeah.
Now, can they stay there long term? Maybe, maybe not. But if it's like, hey, they're giving me 2 months free rent, how can I say no to that?
Yeah.
That's a hard thing to overcome, like a 10, 15-year-old property, when these new deliveries, they just need to get them leased up. And so that's where I kind of see this demand is people are moving into those apartments. People are getting there, but they're not going to ever fetch the rents that they were underwritten to.
Yeah.
And I think that's what we're seeing is the reality is the market was what the market was. COVID kind of inflated some stuff coming back down to earth. And it's like,
well, do you think that, I mean, you said, they'll never be able to achieve the rents that they performed. Maybe one day.
Maybe one day, but not in 2 years.
But certainly not in their stabilization window. And like what you mentioned earlier, what are you solving for? Are you solving for certain rents, or are you solving for occupancy? In these owners, where their pro forma in the plan, they assumed that they could get it leased up, and the occupancy wouldn't necessarily be an issue. Not that it's easy, but that they think they can do that. It's more of like, hey, we got to get to these rent levels so we can hit our pro forma. But as the lease up hasn't been going as smoothly as they wanted to, and their carrying costs or interest payments are ballooning, it quickly shifts to how quickly can we be stabilized so we can bring to market to get off this construction loan. And we've thrown in the towel on getting the 20 IRR. We'd like to have a positive IRR at this point.
We just want to break even.
We want to break even. We want to be able to redeploy this capital, and we'll then put it on the buyer to as upside, as a value add of, you should be able to move rents because our rents are under market. This brand new, beautiful asset, beautiful units that is leasing up, but we're a couple $100 under maybe some of the existing newer product that's out there, or maybe even at the same price point. Isn't this a great, value basis play? But the cap rate is then so low because the cash flow isn't there. And so you're buying an asset maybe at a good value relative to the cost of replacement or basis relative to what's been sold in the market. But when you look at your returns, the returns aren't necessarily
They're not there.
They're not there. They're not attractive. So it's really challenging, and for developers, they're solving for a different problem than they were just several years ago. So, kind of moving on to this RealPage report, and then I want to move on to single family housing. Pricing weakness continues in South and West regional markets. I'm looking at the markets with the deepest rent cuts. Year ending October 2025. And again, Jay and I, Great Capital, we're active in the Midwest and Indiana, Ohio, Kentucky, Michigan, where we've seen positive rent growth. Some flat at some properties, but generally positive. Not a lot of deeply negative rent growth, and it's still hard to pencil deals. I don't know how you pro forma something and buy something and underwrite it when you have negative rent growth with negative rent growth forecasted for future years and significant amount of supply still coming online. So, the market with the deepest rent cuts right now in 2025, it's not Austin. It's actually Denver, Colorado, with minus 8.1% annual effective rent change. My gosh, annual supply by the third quarter is 14,000, and that's only a 4.1% annual inventory growth. That's actually not that large. It's kind of moderate, but they're still absorbing all of the inventory that was delivered, this last year and in 2024. And it's that overhang that is extending the process, and call it pain or whatever you want to call it, when I think there were a lot of investors out there that were like, survive until 2025, the supply is going to fall off a cliff and then rents are going to spike. But it just doesn't happen that quickly.
Yeah, and I think, we even thought it here. We looked at the deliveries, and we've seen the deliveries slow down here.
Sure, yeah.
But I do think it's probably going to take 12 to 18 months longer on that equilibrium that we're looking at. On a lease up, the hardest part on a lease up is for agencies to even look at it. It's got to be 85%.
Yeah.
But that doesn't mean they'll give you debt at 85%, but they're not giving me full leverage at 85%.
No.
And that's, I think, where the dichotomy with a lot of these is these are going to be stuck at 85, 90% for, call it 12 to 18 months, when to get the full leverage and the value for the proposition for a buyer, they need to be higher. And that's, I think, where the real rub is right now, is they're going to be cutting these rents to get to that area where they can get some sort of exit. And that's where I see kind of the friction in the market right now is, yeah, people will lease up a lot of different stuff. I see not saying there's none, but I see very little that's sitting at 60%.
Yeah.
But I see a lot sitting in that 80 to 90% range.
Well, going back to, again, occupancy and demand, clearly there's demand. There's units being leased, there's at lower rates, and occupancy, while is lower in many markets, it's up year over year. So units are being filled. They're just being filled slower and at rates that are lower than what was originally anticipated. I'm looking at apartment rent growth leaders year ending in October 2025. San Francisco is taking this top spot. We've talked about that multiple times. And as Jay and I were discussing before we press record, a lot of that is still a recovery from COVID. And I saw a report this morning that rents in San Francisco are essentially flat based on 2019 levels. They really didn't experience any growth during COVID, where Austin is seeing declines, and it's probably getting close to being flat, but moving the opposite direction, after it experienced 30% rent growth. Now it's had multiple years of, negative 8 or 10% growth. Markets in the Midwest typically had less rent growth than Austin, but still double digit, but then never saw any declines. Have just been continuing to compound. And out there, New York, in that a similar category as San Francisco, although the recovery took place in New York earlier than San Francisco and has been a little bit more stable. Then we've got a lot of other markets, in
I
the
mean, I'd say all
Midwest.
those top four are probably all in the same boat.
I would say I would agree. San Francisco, San Jose, New York, and Chicago. Chicago would be one that I think has slightly different dynamics, given the so little supply that's
Agreed.
adding to Chicago. I mean, annual inventory growth as of the third quarter in Chicago is 0.4%. Now, San Francisco, similar levels, 0.6%. But comparing to, again, when we compare it to markets like, Denver or Austin, Denver is 4.1, Austin's 6.4, but markets like Charlotte are still at 7.3%. Phoenix is at 6.1% annual inventory growth, and it's seeing negative annual effective rent changes of negative 6%. And so, Chicago, which, this is really driven by, political uncertainty and, property taxes in Cook County. You know, there's an interesting argument being made of Chicago as a very attractive market. It's pretty contentious here, even at Great Capital, because Chicago's 3 hours away from us in Indianapolis, and the fundamentals are pretty strong. We know of a group that's buying a deal in Chicago. It's really expensive, like price per unit, but the cap rate seems really attractive. It looks like it's probably going to be a pretty good deal. I don't know all the details, but looks like they're getting a good deal on it. There's a lot of things to like about Chicago. It's just that politics can just wipe your returns out, with a stroke of a pen.
Yeah, and I think that it's the unknown. And I mean, obviously, you have some of the especially the west suburbs there that people are like, okay, you can kind of pencil that in, but it's like, at what point does the bleeding from Cook County bleed out into the suburbs? It's never going to be a 1-for-1, and it's like, there are a lot of people in Chicago, a lot of really smart financial people in Chicago. And if they're maybe not bullish on it, what makes us think we're going to come from Indianapolis up there and fix their
I think
problem?
some are. I think some are, some aren't. I think
Yeah.
some are so burned by the political system that they're not, but others are like, yeah, whatever, we can navigate it, and I know somebody, and it's what we know. Clearly, there's some people that are still trying to make a run for it. Okay, moving on to Realtor.com. They've got their October 2025 monthly housing market trend report. We don't always talk as much about single family, but housing is housing, and they both impact each other. Whether it's on the rental space, multifamily, single family owner occupied, single family rental, BTR. What we learned through the pandemic, really confirmed through the pandemic, is like housing demand is housing demand. The difference between like for rent for buy is typically on the margins. And there is a big marginal argument right now, given the lack of affordability in single family homes versus rentals, that probably is helping multifamily to a degree. But generally, I mean, if we look at it, it's not like multifamily is going gangbusters while single family is being weak. Same thing during the pandemic and COVID, when interest rates were zero. It's not like we saw multifamily in the dumps while single family was rocking and rolling. They kind of move in lockstep. And so, like multifamily having a pretty weak year, single family homes are also having a pretty weak year. Would you have any, before we get into the report, Jay, just any kind of takeaways on the single family home market?
Well, and I can just speak specifically from me and my neighborhood.
Yeah.
Like, it was funny, we had a house 2021, cross the street, 2 houses down. It was bought, interestingly enough, by someone I went to high school with, but they bought it sight unseen from Nashville, moving back to Indianapolis.
Yeah.
And went gangbusters. The house next door went up back in September, listed for sale. As neighbors, we've all known it was going up for sale. They moved out a while ago, but it finally hit the market. It has sat. I don't think I've ever even seen a person tour that house.
Really? Wow.
And it's just sat there for
Do you
going
think
on
their
60
pricing
days.
expectation is too high?
I think their pricing expectation is too high, but the reality is it is still priced below what that house next door went for
Really?
in 2021.
Really?
And so I see this kind of push and pull where it's like you said, the supply is down. I just think people are disenfranchised about the housing market. And if you don't have to move, why?
Yeah, well, we've had similar kind of personal conversations about like, looking at, looking at houses and, personally moving. And I think we've had similar experiences of like every time, our spouses have been like, hey, what do we think about moving? You pop on Zillow or Redfin, you start looking around, and you're like, there is nothing out there at a price point that makes sense that's compelling enough to make me sell my current house with a current mortgage at a relatively low rate to go through the whole process of moving. It's you get to a point where it's like it's not an option,
No.
and like we're not even considering it. Do you have similar
Yeah,
thoughts?
similar thoughts. I mean, I know that like when my wife and I bought our house, we kind of saw it as like a starter house. Maybe like kids could be there. Like we had enough bedrooms that if we had kids, but we kind of thought like, hey, as we have kids, maybe we'd have to have a little more space, especially yard, something like that. And I mean, we look at what it would take to get what we want. It's like,
A couple more deals
yeah,
later.
a couple more deals. But even then, it's like, what's the risk return on
Yeah.
that of like, I could do that, but then I'm going to increase my commute to work. Like, am
Yeah.
I going to be able to use it? Am I like, there's kind of all these other factors where it's like, stay here, go to the park, let them run around at the park, as opposed to like, hey, have a
It's working.
1 to 2 acre yard in the backyard.
Yeah. And so it seems like so many people, I think, have come to a similar conclusion, whether they're in an apartment or whether they're in the home that they own or rent, of they're just taking that idea of like moving and just they're putting it in part of their brain that they're not going to just revisit for a while.
Yeah.
I mean, it's just not an option. We're going to stay, and that's showing up in the numbers on our, like you mentioned earlier, on our retention rates are, up, 100, 10 percentage points,
Yeah.
over the last year. It's pretty interesting. Some of these takeaways in the summary from the Realtor.com report, the inventory climbs, but the growth is slowing. Active listings rose 15.3% year over year, marking the 24th straight month of gain. So there is some inventory coming online. Regional divide has begun to narrow slightly. The buyer activity remains soft despite lower mortgage rates. I mean, I think, lower. They're still relatively high compared to the, pre-pandemic. Prices hold steady nationally, but fall in the South and the West. I think the fact that prices are still relatively stable, I think surprised a lot of people given where rates are. Probably underlying some, fundamental demand given demographics, but just it's tough as the pricing. And then now this is interesting. The shutdown weighs on buyer confidence and housing activity in federal metros. I'm sure that's the case, in Washington D.C. and elsewhere. But I think that take the federal metros out. I just think in the shutdown, the federal government shutdown is just another factor that's adding to the uncertainty and just that underlying uncertainty and low consumer confidence is leading people not wanting to make a big purchase. I mean, if you're concerned about your job, and if you think how many people are concerned that AI is going to take their job, whether it will or it won't? And do you want to go make a big home purchase when you're like, I don't know if there's going to be a recession. I don't know if I'm going to lose my job.
I mean, given who the largest employers, I was listening to a podcast a couple weeks ago where they talk about who the largest employers in the country are: Amazon, Walmart, and I forget who the other ones are. But it's like, okay, none of them are projecting necessarily cutting jobs, but most of them had like 5 year growth plans where it's like, okay, if we're not adding jobs, well, maybe they still are adding jobs, but as people are transitioning out. So it's like, do you want to make a decision where you're kind of on that
Yeah.
outsized thing? And I mean, as so many people are, even if they're not employed by Amazon, how many people are influenced by Amazon? I mean, we've looked at Northwest Arkansas before as a market. It's not something we're looking at now, but you look at that market, how much of that market is like Walmart. And I know part of it is like Walmart requires like any suppliers to have stuff in that area. So they actually are doing a good job to kind of drive that. But I mean,
Still, it's a lot of concentration.
That's a lot of concentration that all of a sudden, if anything's changed, that,
Yeah.
like you said,
I was listening to a Jay Parsons Rent Roll podcast and commenting on some of the Q3 REIT earnings calls, and there was a quote. I forget which REIT, if it was Camden Property Trust or which REIT it was, but I want to say it was a very large percentage. I want to say about 20% of their residents worked for Amazon. I mean, that's a huge concentration. I mean, if we did an audit of our portfolio, there's a big chunk because how many Amazon fulfillment facilities are near some of our
Well, I
properties?
was going to say, I can think of two specifically that are near Amazon and FedEx facilities that it's like when we bought them, that was kind of the thesis is those are the growing industries right now.
Yeah, yeah, e-commerce and whether it's Amazon or other, but
Yeah.
Amazon's got a lot. Yeah, over on the east side and west side. I'm just going to go to one of these other another chart, just looking at inventory of single family homes. And again, this is kind of similar to the list that we saw on RealPage with Austin and Denver supplying the most single family homes. But and this is inventory recovery from the spring to fall, May versus October 2025. So it's kind of just the movement in inventory relative to the percent above pre-pandemic levels. And so, there's a decent amount of markets, call it, a third that are above pre-pandemic levels. The West has the highest average of, inventory that's coming on, recovering above pre-pandemic levels. The Northeast is seeing some of the slower growth and followed by the Midwest. But again, I think a lot of this is kind of in the belly of the curve, more or less. But again, I think it just highlights some of these high growth markets that are experiencing a lot of population growth, a lot of employment growth. But it just, this picture, when I see Denver, Austin, San Antonio, Seattle, Dallas, San Francisco, Tampa, Orlando, Nashville, San Jose, Phoenix, Tucson, there's so many of these markets which are experiencing slow negative rent growth. Again, this is just a lot of housing inventory. We know there's a lot of multifamily housing inventory that's going into these same markets. I don't see them having a rent recovery in the immediate future. At some point, it'll all catch up, but they're still building a lot of houses, a lot of apartments.
Yeah, and I think that, like, to your point, it's interesting because, like, when I look at this, these are also what I think of as like your quote unquote destination cities as well. And like you said, I'm sitting here like looking at Tampa, and it's like that seems like that should be where people want to go. And I realize there's been a lot of development down there, but then you also see in the news about how Florida's pricing people out,
Yeah.
and maybe people don't feel as good about being in Tampa anymore.
Yeah, I've heard some anecdotes of there's some recovery going on in Tampa, but definitely struggling with a lot of inventory. But this list, go back to the RealPage report of the markets with the deepest rent cuts. I mean, this is like a list of the markets that were like the top investor markets, top syndicator and institutional investment markets.
If you were a developer and you didn't have a deal going up in one of these markets, what were you even doing?
Yeah, are you really a national developer if you weren't developing in one of these markets? And so it's just part of me. I just have a lot of mixed feelings. On one hand, I'm like, okay, well, we're in a much better region, partially just because luck. That's where we are. That's where we're based, and we just double down on that. But does this remove investors from the market because there's gonna be a lot of losses because a lot of these markets were overly invested in? Does that shift some investment to other regions? Any take on, I guess, just investment preferences and some of these have been just steadfast stalwarts of the multifamily investment thesis for a lot of investors.
I think that what is the crux of these is what are the banks going to do? And what do these owners and developers have the capability of doing? Because the reality is, if you developed in here, maybe you got lucky, maybe you got out. But if you're holding it right now, you're not looking at the prospect of making a lot of money. So are you just trying to get out? And you're willing to take a loss, do whatever. Are you just trying to get out? Are you willing to hold it and try to weather and just understand it's going to be a low return, but I'm not losing money? Is the bank going to take it over? Like, are you in that bad of shape? And so I think my thought on the sentiment of these is like, what is the concentration of that? Like, if bank takes a lot of stuff, Phoenix is the one that kind of is sticking out in my head of like vastly overdeveloped, low rent growth, like lots of supply, definitely not hitting their rent projections. Mm-hmm. We've heard lots of stories about syndicators in the Phoenix area, and
Yeah.
That's the one that sticks out in my head of like what's happening there.
The challenge is the banks. Not only do they not want to take over the keys because they're not good asset managers. I was talking to a banker recently, and they also they don't have loans to replace them with, and so if they foreclose and that comes off their book, they don't have that book of business anymore, and all of a sudden, their cash levels, are going up, and they need to deploy that cash to create revenue, but there aren't the deals to deploy into, especially the regional banks that typically fund development deals. And so the banks often, I think, are putting their head in the sand, and they're just like, tell us when it's over and tell us when you can give us our money back. But until then, we don't really want to know what's going on. And that's fine if we have to modify a few things, we can at least keep it on our books and we have a plan.
And that's where I see a lot of these, because I mean, you would have told me 3 years ago I could buy in Nashville, I could do all that. And the reality is I could try to go to Nashville right now, and if I can almost guarantee if I went to talk to a broker, I would still scoff at the price they tell me that it would take to get into Nashville.
Yeah, you'd still pay a relatively low cap rate. Even if you paid a 6 cap, again, underwrite even a 6 cap with negative rent growth. It doesn't work.
Yeah.
The numbers don't work, even if you have positive rent growth by year 2 or year 3, which may be overly optimistic. You really have to be betting on something that you just have to be just ignoring a lot of the data and just saying, hey, we're going to figure it out, and there's going to be some rent growth, or somebody's going to pay a insane price because I'm just purely focused on the basis. I think that's a good transition, Jay. I want to read a quote. You sent me over last night a quote from Seth Klarman from the famous, I don't know what you want to call it. I want you to give a little history because you know more about it than I do. His book, Margin of Safety, I think came out in 1992. And I'll just read it real quick. Investors are sometimes their own worst enemies. When prices are generally rising, for example, greed leads to investors to speculate, to make substantial high-risk bets based upon optimistic predictions, and to focus on return while ignoring risk. At the other end of the emotional spectrum, when prices are generally falling, fear of loss causes investors to focus solely on the possibility of continued price declines to the exclusion of investment fundamentals. Regardless of the market environment, many investors seek a formula for success. The unfortunate reality is that investment success cannot be captured in a mathematical equation or a computer program. Why'd you send that over, Jay? What's your takeaway?
So I came across this book a couple years ago. I was on X and I was listening. I think Bill Ackman was doing his books for the year that he was recommending people do, and he kind of gave a summary of it. And it was, I think, at the start of 2024. I think it was the books of the year, and he did it at the beginning of 2024. And obviously, we had just come out of 2023. We weren't doing any deals at the time. We were kind of looking at, okay, what's our next step kind of going into 2024. And I had heard about this and I was like, okay, I realize he's kind of on the institutional and he's on the equities side, but I just feel like it kind of always in the back of my head of hey, I want to read that book at some point. And finally I was sitting at kids sporting events last night, and I finally I pulled it up and I was reading through it, and I read that, and you and I had just had a conversation about how do we make sense of these deals? We're banging our head against a wall. Do we stretch? Do we be conservative? And I just was struck by that quote of almost exactly what I want to say. It's how many times have you said, when we pull up the model of show me the return that you want, I can make our model hit it.
Yeah.
And it's we saw the,
not in a good way,
yeah,
but as in you can manipulate the numbers to say anything.
And back in 2021, 2022, when we saw the mania, think of how prevalent equity was. We had people calling us all the time, can we place money?
Well, the numbers, if you just rely on the numbers made a ton of sense in 2021.
Yeah.
Because the debt was low, the cap rate interest rate spread was wide, and rent growth forecasts were very high.
Yeah. And so there was kind of this mania. Well, now all of a sudden everything's kind of come back down to earth. And you and I have been talking about it for probably the last 2 years. The reality of this idea of the basis buy and what is the relative cost of replacement versus the economic value. And at what point is that reconciled? And there's probably 3 deals you and I have been like, we should pile a bunch of money into this deal. It makes sense. But I put it on paper and not a single investor would be excited about it.
Yeah.
And I would finally last night I broke down. I'm just like, I'm trying to understand, okay, like as we go through here, like reconciling what we know about the numbers, what we know about our market. But then it's like, okay, what is kind of a risk adjustment, and like how do I think about risk? And it was like I said that you and I have had these conversations, and you kind of know my thoughts about some of the financial engineering that was happening previously. And he kind of in the intro gave the story about trading sardines and cans of sardines. And it was like everyone's trading all these cans of sardines, and one guy's like finally tries to take his like profits off the table. He's like, I got all these sardines. Let me eat a can of the sardines. He opens up and they're completely rotten and rancid. And then someone turns to me, he's like, you're not supposed to eat the sardines. You're supposed to trade the sardines.
Yeah.
And I feel like that for a period of time, like that's kind of what was happening in our industry. Like like you said, cap rates were so low, our interest rates were so low, cap rates still had a nice spread. And so like everything made sense on paper. And so you could make a lot of sense. Banks were giving you money. And so you could make that trade. And it's like, hey, I can make money off of this. And if you set it up with the right debt and you had the right operations, you were fine. If you didn't, now all of a sudden you're eating one of those rotten cans of sardines.
Well, then when you actually have to go and like sell the sardines by the sardine, and they have to be like edible,
yeah,
it all of a sudden starts to matter, and that's when I think you start shifting from pure speculation to actual investing or operations. And the analogy in the multifamily world that makes sense to me is that the period of when you could buy something and you could have a value add plan, but cap rates were just compressing. Someone could execute poorly, and then you could sell it in 2 or 3 years and still make a lot of money, regardless of whether you added or extracted value from the community, whether residents were having a horrible experience, whether your employees were having a horrible experience. It didn't matter. It's because someone else was willing to pay more for that can of sardines or an apartment. Now we're living in a world where the sardines have to be decent quality. And people are starting to say, I don't want the old sardines, because there's a lot of like new cans that are out here that were just like a shipment of
brand new cans, fresh hot.
Just hit the shelves, and they're going for a discount. And I'm not going to buy your old crappy, stinky sardines. And so the advantages for operators, it matters all of a sudden to being able to execute a value add plan and actually achieve that pro forma rent, that rent premium, or to provide a living experience for residents of where they're willing to pay more rent, where your operations actually have to work and you actually have to be a good operator to make money, to make an investment work, and actually to get cash flow, not just leave some meat on the bone and tell a value add story for the next buyer to pay an artificially low cap rate to just cycle out of the next one.
Yeah, and that, I would say, for a good 10 years, that was the story.
Yeah. So how do we shift? How do we shift, and how do you look at deals now, more from, I guess, that value perspective, and also from a pure, like, how are we going to operate this to make money?
I think it's difficult. I mean, obviously, like, we try a lot of different ways. We obviously look at anything that's marketed. We have good relationship with owners, so we try to see if we can get some stuff off on market. But it's like when a broker brings a property out, they bring out like the purchase price and the cap rate of the purchase price. But the reality is there are costs associated beyond just the purchase price. So obviously we have to look at kind of our all-in yield, and we have to figure out what the actual like return on the total money we're investing is. But even the brokers at the broker dinners last week that were here, they were like, well, everyone's looking at in place. Yeah, everyone's looking at in place. Everyone got sold that story of the value add for 10 years. It's bitten probably everyone that's in the market. And people just aren't excited to try to bite that off again. And I think it's, as we are looking and buying in the market, we're buyers playing chicken with other buyers of like, who's going to pay that little bit more? Because I mean, I'd say there's probably 3 deals we're looking at right now. I know many of the other owners that are looking at it. I would say,
hey, stay off our deals, guys.
I know the range that they're looking at. I may not know the exact number, but I tend to know how they underwrite, and I know how they've come in on other deals, and they're probably coming in pretty close to where we are.
Yeah.
And none of us are coming in at probably the seller expectation price.
Yeah. Is this healthy? Do you think it's reintroducing some discipline into the industry?
I think it's healthy. It makes it difficult. You and I were having,
but should it be easy?
It shouldn't be easy. But I do think that you and I had this conversation this morning, kind of on a different one. But in an efficient market, like, things should be priced kind of appropriately. And I struggle with multifamily because multifamily is this thing that it's not efficient. Like, we have really good brokers, we have great relationships with those people, and we have very intelligent people. But just the intricacies of the deals, like, it's hard to be like, hey, this is exactly worth this, it's exactly worth this. But as you pointed out, when you have time to make these transactions and when they're illiquid, you can't make an emotional decision to sell something because it doesn't feel like it's going well. You have to be disciplined. You have to, like, go through a process. And when you have to go through that process, time forces you to make a little bit better decisions.
You can't. It's harder to panic sell. It's very difficult to panic sell a multifamily property. Can you do it? Sure. But, there's a little bit more restraint because there is a process. But there's less inventory, though. So it can be kind of priced to perfection in some ways because everyone's kind of has the same data and everyone's kind of solving for the similar return, 50% IRR, 2x over 5 years.
Yeah, and so that's kind of where it is as that process is slow, it kind of funnels it down to where there really is kind of an exact price. Like, are there people that have bought stuff for prices that I wouldn't pay? Yes. But can I tell them that they overpaid for it? Probably not.
Yeah.
And that's where I think we're kind of getting to as a market. And it's just, where are you comfortable with your operations in getting to those numbers?
And so I guess, where do we find the value? Where is that value trade? And if it can't be based on pure, organic growth, there's not a ton of growth, how much can you rely on, like, the basis buy and cost of construction or cost of replacement? Because a lot of deals today, you see them advertised as a discount to peak pricing or a discount to replacement or discount to comps, and that can be a meaningful, like, metric of, like, okay, well, sure, it's less than it was or less than other things were, but those things could have been overpriced, and
shouldn't have been built. It
should have been built, should have been bought, but it's irrespective of the actual return. And, like, yeah, you can buy it for less than it was built, but if it has a zero return, it's still a zero return.
Yeah.
So how do we make sense of that? Because you could still say, looking at something at an amazing location, and it's like it's a fraction of the price as it was 10 years ago. Is that not enough to go and buy it?
It's hard. And if you had asked me this a year ago, I'd have a lot different thought than what maybe I do now. A year ago, I'd have been like, I really want to buy that. I may not be able to put something on paper that can get people excited about it, but I really want to buy it. And if we don't have the investors, then obviously we can't. But, like, in the back of my head, I'd be like, well, how do I make that work? I think today, based off of what we've seen with kind of the pricing uncertainty with those deliveries that we talked about earlier, it's just so much harder to say, oh yeah, I would buy that, or no, I wouldn't buy that, because you just don't feel comfortable because of that lag. Like, we kind of thought there would be a cliff. Well, there's not really a cliff. So before, I would have said they are mismanaging that for certain. Their rents are below market for certain. Like, I can do X, Y, Z and get you there. I'm probably right, but I thought maybe I could have done it in 12 to 18 months, when the reality is, because of where the market is today, maybe it's 3 to 5 years. And that's not really an investment our investors are looking for.
Yeah. So given all this, all the the difficulties in the market, slow growth, are you surprised that sellers are still getting their prices? It appears that some are. And like, what does that tell you about investor demand for multifamily.
It's hard.
At least in the Midwest, in the markets that we're
in the markets we're in, it's hard because like they're getting their price, but you and I have conversations like, okay, what are they trying to solve for? And I think it's like, what are they trying to solve for versus what we're trying to solve for? Because like, if I went through and I put the price that I know some of these have gone for, and I brought that to you, like it'd be like a 9 IRR, and we would never raise money for that deal. Like, it just wouldn't happen. And so that's why I think the biggest difficulty is like, okay, where can I find that deal that hits the returns that we need?
So for that group that's doing the 9 IRR deal, is it because 9 IRR is all that they need, or are they speculating, or are they being more aggressive on their assumptions? And so in their mind, it's
it could be
12,
that
13,
or
14,
and
15.
there's some people that like, it kind of depends on if you're raising money or if you have your own money. And I think even your own money, it's different. Like, do you have a fund?
Yeah.
Are you a family office, or are you raising money? Because I think especially with some of those family offices, they're in wealth preservation mode. So for them, a 9 IRR on something, yeah, I don't need the money today. Cash flow
Low
is
leverage,
nice,
especially lower leverage.
Yeah.
Plenty of
but
margin for safety.
But it's a nice store of value.
Yeah.
And so that they're willing to buy that prime location that maybe a little bit lower cash flow right now, but is going to do well in the long term. And if they hold it for 15, 20, 25 years, an IRR on a 25-year deal that you hold is never going to look good,
Yeah.
because time value of money. And so if you're not trying to trade out of it in 5 years, then it's like, okay, what is the total like return on that? And so those people can really feel convicted about a location or something like that and make those investments, and it's their money, they can do that. When you're raising money, like we talked about a few minutes ago, like, what gets an investor excited? Like,
Yeah.
what's the emotion that gets an investor excited about a deal? And it's the numbers, it's the story, it's all of that. And then if you have a fund, it's like, okay, how am I diversifying? Like, maybe I can take a little bit lower. Like, I know there's a specific deal you and I have talked about that. Like, if we had a fund, I am very convicted about the location, I'm very convicted about product, but it was like 1 percentage point below kind of like our threshold for
Yeah.
what we're going to do. But if we have a fund where I can average that out over across 5 properties, I feel that it's very accretive to our portfolio, because it allows us to get scale in certain areas and efficiencies in other ways. And so I think that different investment theses have kind of created some of the distortion we're still getting in the market, where maybe there's a deal we really like, and it's like 5 people are all at that price, and then it's
There's
like
one property, in a MSA that kind of like fits a certain criteria, but there may not be a ton of buyers, but there's enough. And
Yeah.
if one is solving for a tax solution, or if they're looking for a low return, or they want a low leverage, it's just going to be tough to compete if you're solving for traditional, private equity syndicated real estate returns. Again, the 2x over 5 years.
Yeah.
It's tough, and cash flow long to boot.
and that's something, and it only takes, it's not like a stock price where there's tons of stocks and people can kind of all fight over
Yeah.
many different stocks.
Yeah.
It takes one buyer.
Yeah.
It takes one
Yeah.
buyer that needs to solve for that.
And it's not exactly the most exciting time to bring a deal to market.
No.
Some properties have done really well. You've owned them for a long time. Sure, recycle the capital, but like, from our perspective, like, there are some properties that we wouldn't mind trading out of because investors are like, hey, we've owned this for a while. Can we return some capital? And it's like, well, if we can get a price, but we very confident prices are going to be better in a couple of years. We certainly could be wrong, but I think both of us that feel that way. Whether we continue to grow NOI and get a better price, or we get some cap rate compression over time, the market normalizes, and because I think everyone would acknowledge that the market right now isn't normal.
I would
and
agree.
that we're in some range of the trough. We're certainly not at the peak. We don't know where we are on the spectrum, but we're certainly in before pre-recovery or just starting to get into recovery. Back just real quick about why people are buying and solving for different problems. You mentioned a store value. Is multifamily a good store of value? And talk about it relative to maybe gold. Obviously, cash isn't a great store of value. But then even like Bitcoin, or any other sort of store of value. But do you think of multifamily real estate as a store of value, or?
It can be. I don't think of it necessarily as a store of value, But I mean, I do think of it as a store value relative to operations. I mean, we've seen it here locally. There's a developer who has done. They're going on their third project here locally, where very very high net worth family, and they are treating it as a store value, but they have a store value for the real estate, and then they own the opco that runs everything, and there's some of the nicest properties in the area.
Yeah.
Everyone's very enamored with what they do, and for them it works.
And then a lot of that's time frame also.
Yeah.
Because if you're working off of a multi-decade time frame versus 5 years, you can make some very different decisions.
Exactly. And like you can build that, you can make that a little bit nicer on the front end. You can invest a little bit more on that construction cost, as opposed to, hey, I need to build this as efficiently as possible so I can get out before my construction loan expires. But if you're going to build it and own it for 20 years, you understand that you want your opco to have as little issues with maintenance as possible. So you're going to spend that extra $5,000 a unit on the front end to make this decision here and make that decision there. So that way you save however many thousands of dollars in future years.
Yeah, it'd be nice if they decided they wanted to sell something. It'd be nice to buy a property up by Keystone. One piece of margin of safety, and this is a really good lesson that I think that it was kind of drilled into me when I was starting to get into investing, and especially multifamily. And it's this idea of you're chasing a risk over return, and the emphasis the emphasis of avoiding loss is more important than chasing high returns. And often when we are, raising money for projects, we got to hit a certain return, and so you feel like you're incentivized to chase some high returns because investors are like, do they get excited? They want it. Everyone sure wants to hit something out of the park, but as a point of the book, one wrong bet and one wrong investment can wipe out all of those gains.
Well, and I think of it this way, like the math equation, I think you and I talked about before. A 50% loss of equity on a deal means that reinvestment has to return 100x, or 100%, 1x of what you had. And so a smaller decline makes a much harder increase on the back end.
Yeah.
And so like when you think about like what it takes to recover from bad decisions, it's like, oh yeah, I don't want to have to be, just to get back to zero, having to double my money.
Yeah. And, I think it's something that we've kind of had in the back of our head from since we started doing deals, and knowing that like, hey, one deal that goes south is probably that's the last deal we're ever going to do, and we're out of business. In reality, especially nowadays, there's a lot of people with bad deals, and some of them are still in business, and especially big firms, deals go south not all the time, but frequently enough. And if you're in the business long enough, you're going to have a deal that goes south. But I think that having that principle is important, because it's easy to just if you don't have that, and if you're just like, well, I need to get the highest return, it's easier to take a flyer because you're just not thinking about the loss, versus I'm really trying to protect the principal here, and a loss isn't an option.
Yeah. And I think you and I have said it before. And I think that some of the people, like some of the risk we see in the market, was exacerbated by the fact that, I know I've said it when I've been on the show before, like for 10 to 15 years, no one in real estate lost money. Well, not no one, but like very, very few. And as you said before, a bad operator failed up for a long time. And so it was easy to get away with bad decisions. And then we've seen some serious corrections in the last 2 to 3 years on that, where you couldn't just do that. And I think that's something that, like, as we look at this in real estate, not saying people are going to get comfortable with loss again, and I never want to get comfortable with loss, but what is the sentiment of it? Like, no one thinks twice about, hey, I think back, one of my first experiences with the stock market, I remember, was the old TV show King of Queens. And I remember like Kevin James, his character, like one of his buddies at work told him to buy this stock, and like he bought it, and it was like went down the day he bought it, but then he sold it, and then he like it went up like 10% the next day. And like, it was this emotional roller coaster the whole episode. And at the end, he's like, I'm never investing in the stock market again.
Yeah. That happens to a lot of people.
And that was one of my first memories of like understanding what the stock market was. Now, granted, obviously maybe it is the good picture or not picture, but that's kind of the speculation side of it. Is like a buddy at work kind of told me, hey, invest in this stock. And I think from like he hated it, never wanted to get about the stock market again, but like he was okay selling that at a loss.
Yeah.
Whereas in real estate, like we talk about the developers now, these developers want to sell at a loss. Like they're like, I got to get my money out. I got to get, not just I want to move on, but like I got to get my money out.
Yeah. How much money can I get out?
Yeah.
I'll take 80% of it.
And I think one thing that would be healthy in the market is seeing some of those deals that like sell for the price they should sell for. I think some of them, there have been a couple of deals that like, I think that one Hail Mary buyer came in and saved a couple of deals. So I think some people are holding out hope that person comes for their deal. And so I think either recovery and rents and NOI getting and interest rates coming to the point where, hey, we can get out, we can just be level, or those people like understanding the loss, being willing to take it, and then the market resets and people understand kind of what the market really is.
Yeah.
Because right now I think people have an idea, but I don't think people really know what the market is because there's been enough of those kind of like.
Do you feel that it's frustrating because we know kind of where things probably should trade, but they're trading at a lower cap rate? It's interesting. We learned last week our acquisition of a property salon in Indianapolis, according to the broker that sold it to us, and they held a big industry event last week, was essentially the deal that kind of unlocked and unfroze the Indianapolis multifamily market, because there was a massive widespread of price discovery, of where maybe you could find some intrinsic value. Now we were not the first bidder on that property. Someone had bid on it and they blew out of the deal, and we came in and negotiated a lower price. But still, according to the deal brokers, there was some 20 some bids and a huge massive spread in offers, and some people were just just lowballing the deal. We feel like we got a really good price on it. It's a great property. How do you feel about kind of unfreezing the Indianapolis multifamily market, kind of setting at least one of the first data points? And now that we've acquired another big deal in Indianapolis, there's been other transactions that have taken place. Do you feel like there's starting to be a little bit of clarity, even though it's not at the prices that we would like, but are we responsible?
It's interesting because like I feel like Solana specifically, like that was one where I felt really good about it. I think in the office we were like, okay, if we can get it at this price, it makes a lot of sense. I remember you and I, when we were in best and final, it's like, well, should we go here? And we're like, nope. And we reduced our offer.
Yeah.
And I think it worked out. And then even on flats, I think flats, I feel very convicted about how we bought flats, and I feel really good. And then I see some of the other things that have traded in the Indianapolis Metro, and I look at it and I'm like, I'm glad we got this deal. Like, and so I do feel blessed that in some of the deals that we've won, I'm very like, I think we were looking in areas that maybe other people were avoiding. Mm-hmm. And I think that's been very good for us. I mean, the easy thing would be us right now to be going up in Hamilton County for the 3 deals that are trying to trade up in Hamilton County right now and throwing gobs of money out there. But none of us feel good about that right now.
No, it goes against a lot of all this, value investing that we're talking about. We're speculating. Now, again, there's great demographics up there, but there's better value elsewhere. I think we'd both agree there.
100%.
Kind of closing things out, I guess, how do you manage some of these emotional swings, kind of making sense of it? You're making big bets, investing tens of millions of dollars, hundreds of millions of dollars over the last couple of years. And in a uncertain environment, getting these deals done, they're not easy. How do you keep your head screwed on straight, or at least you appear that way most of the time?
I think it depends, obviously, kind of where we are in the process. Obviously, if you looked at me the week before we were closing flats, I was in here the day we closed it, and I probably had eyes glazed over.
Yeah, you should. Well, you can see Jay. You actually can go to the episode. We'll link that the link below. Because when we were in the process of closing this deal, Jay was, basically sequestered in his room or his office, and I would come in there and just kind of sit there while he's just cranking through, our settlement statement and going back and forth. And once he kind of didn't have any more work you could do, waiting on wire confirmations, I dragged him into the podcast studio and we did a quick episode, which was really insightful. Were able to manage it? I mean, again, it was a stressful day because there was a lot of just like work to do and the amount of communication that goes on that one single day. How do you do that? And then, but again, you have to sustain yourself throughout that entire process.
I mean, for me, the front end of it is actually, I don't want to say easy, but the front end, because of like the work we do on the analysis and like when we underwrite, like you poke holes in it, our analyst puts it together, I review it, you poke holes in it, our property management team pokes holes in it, our investor servicing pokes holes in it because they know the questions that investors are going to ask. So when we put in an offer, I feel very, very good, and I feel very convicted of where we are at. As we do the raise, obviously there is like the stress of doing a raise when we're trying to raise the money and do due diligence and all of those things. Like there's a few different balls in the court. Fortunately, they're not all my responsibilities. But then, I mean, if there's any hiccup on, like if we find something on DD, which we've been fortunate not to, like on flats, but then like we did have some hiccups with some equity. We had some hiccups with debt. And because of how that equity was structured, obviously it directly affected our debt. Those are areas where it's like, you start to feel it because you need everything to go right.
Yeah.
And it's taking a breath and getting through everything on kind of those deals and just kind of blocking out everything else and kind of getting across the finish line. And then afterwards, like, I took a vacation the next week and I decompressed and I basically like
you went on another vacation.
Yeah, I basically shut my phone off when I was gone because I was able to kind of get away and do that. And I mean, now that I've come back, I feel much, much better. But I think the ability to kind of step away and do that was very helpful after the fact. And I remember when we did Club Meridian a few years ago. I remember I was walking laps about every hour around the building. As we were doing the equity raise, as we were doing.
Jay and I talk about if you want a weight loss plan, just do a big JV deal,
$28 million.
Yeah, and have your interest rate, the 10-year Treasury rise 100 basis points, and have to retrade while you're $1 million of non-refundable earnest money in an escrow. You'll burn some calories.
I think I lost 30 pounds during that race.
Yeah, it was insane. We both got nice and trim. Well, Jay, thanks for coming on. You'll have to come on again shortly. Hopefully, we've got a great deal to talk about at some point. If we can find one that we can make sense of.
We're trying.
We're trying. Hey, make sure if you're not a subscriber to the Great Capital YouTube channel, and especially if you're still watching at this point, do us a favor and subscribe and hit the bell icon. That way, every time we put out a video of the Gray Report or any type of video content, multifamily content, you're going to get notified. But in addition, we have the best multifamily newsletter in the industry. If you go to graycapitalllc.com/newsletter, you'll be able to sign up for the Gray Report. And again, it is a digest of all the most up-to-date research reports, articles, data related to the multifamily industry, but also the macroeconomy, commercial real estate, residential real estate. It's amazing. At some point, I want to find a way to share the people who read the newsletter. A lot of media outlets pick up the newsletter. A lot of industry media outlets read the newsletter. Top developers, owners, investors, a lot of industry insiders. It's humbling to see who reads it. It gets sent out to about 16,000 people every single week. It goes out every Thursday. So again, graycapitalllc.com/newsletter. Check it out. And if you are an accredited investor, you can hop on the Great Capital website, click around, press some buttons, sign up for our portal, and you'll be notified for our next deal. But you got to be accredited investor because the SEC don't really trust you with your own money, unfortunately. So, okay. Well, Jay, thanks again. We'll catch you on the next episode of the Great Report.
Thank you.